Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'll be discussing our April 14th energy update, which again asks, is natural gas's decline into the spring shoulder period an opportunity to hedge the cost of natural gas and electricity? Natural gas is the largest power source for electricity generation. Therefore, their pricing is highly correlated, which is why we focus on natural gas in our reports. In our March 24th energy update, we explained that spring shoulder periods occur between the winter heating and summer cooling periods, and the fall shoulder period occurs between the summer cooling and winter heating periods, when demand for natural gas and electricity is at its lowest point of the year. Therefore, with demand declining as we entered this year's spring shoulder period on March 24th, it was not surprising that natural gas declined from its highest price in more than 2 years. As we explained in our last report, although natural gas may decline further during this year's spring shoulder period, with supplies ending the winter heating season 10% below the 5-year average, this year's decline would likely be very shallow, and the risk of higher prices remain very high. Now, why is the risk of higher prices very high this year? As we explained in our December 2nd energy update, that although the Trump administration's policies promoting increased production will mitigate the impact of surging electricity demand domestically and exports internationally, demand is expected to outpace supplies, which supports the observation that when prices were as low as they were in 2024, it always preceded cyclical bull markets that trended higher for 2 to 4 years. And it didn't matter who was president at the time. Therefore, past cyclical bull markets indicate the present market is not near its conclusion, and there will be likely at least one more painful rally in the future. The trigger could be a warmer than normal summer or a geopolitical event in Europe or in the Middle East. We cannot say with 100% certainty what the next trigger will be. Our role as energy advisors is to identify potential risk factors to help you make an informed decision concerning the timing of your next hedge. A classic pattern during cyclical bull markets is a series of higher highs and lows. If this pattern continues to hold, we may be near its conclusion before the next move higher. Now, based on the long and short-term patterns discussed in today's report, we believe the upside risk is far greater than the downside reward potential. Therefore, we recommend anyone with agreements expiring within the next 18 months take advantage of the recent short-term decline to reserve natural gas and electricity to be available when their present agreements expire. Not every client's risk tolerance and hedging strategy are the same, but hopefully today's report helps you understand your risk-reward opportunities. We invite you to contact one of our energy analysts to help develop a hedging strategy that will be tailored to your specific situation. And until my next report, please take care.